Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to the calculation of return on investment, ROI. Get ready, because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area on the right-hand side, focusing in on the calculation of return on investment, ROI. Return on investment is often one calculation that we can use when making a decision-making process. For example, if we're thinking about putting some type of investment into something and considering what the return will be, what we're going to get on that. In other words, oftentimes when we're thinking about an investment type decision, we're thinking we have to put money down up front in order to achieve some type of goal in the future. And so we want to think about that comparison, the gains versus the what we have to put down up front. So let's take a look at this. We got, should we expand to a new product? That's going to be our question. If we do so, the assets to support the expansion costs are going to be $500,000. So we're going to say, okay, it's going to cost us $500,000 up front. That's the initial cost. The estimated revenue is going to be $2,040,000, and then the profit margin is going to be 4%. So, and we're going to say that's annually. So we're going to say, all right, we got to put the $500,000 down. So we know what's going down. What are we going to be receiving? What are we going to be getting from that? Now we're going to back into that basically net income number using this profit margin percent. So you might do this way. You might think of the profit margin percent and try to figure that or remember that calculation. We took a look at that in a prior presentation, and then back into basically the net income. Okay, so let's think about that. We're going to say, all right, we got to get to the net income. Why? Because I know we put this amount down, but I want to think what we're going to earn on it after basically any expenses related to it. So we're going to take then the net, we're going to take the net revenue is going to be the $2,040,000. The net income I'm going to make yellow. That's going to be the unknown. We don't know what the revenue is. We know the profit margin then is this 4%. So it should be net income divided by revenue equals the profit margin. Let's go to format this, home tab, numbers. I'm going to format this. We're going to then let's put a double underline on it. Let's put a single underline up top, single underline there. So then I need to solve for net income, which would be the calculation of X divided by the 2040000 equals the 0.04 or 4%. So we can do that calculation here. I'll do it kind of in a vertical fashion. So now we could say, all right, and this would be the algebra. So now you have this and you could solve. So I'll do that calculation here. We could say, and this is going to be quite common that we can think in these terms. We can say, okay, if the revenue is this, then I think the profit margin is going to be 4%. So I can jump right down then to basically the net income, the bottom line number. So I'm going to say, all right, the profit margin is going to be the 4%. The 4%. So I'm going to say, okay, home tab, numbers, I'm going to make that a percent, and that's going to give us the estimated net income. So the estimated net income is going to be here, which is going to be equal to the $2,040,000 times the 4%, and that's going to be the 81.6. So the 81.6, which you can kind of prove this way. If this was then the 81.6, then we should be able to take this number divided by this number and get to that 4%. Get to that 4% once again. So this will actually be a kind of a common way that you might see this once you start working with the profit margin. The profit margin, we're going to say 4% profit margin. So if we start at the top line number, revenue, multiplied times the profit margin, we get to the bottom line, the net income, which is basically what we're getting after a year's worth of time from the investment that we put in for the new product, which was the $500,000. So we kind of reversed, and then the gross profit calculation, if we were to find the gross profit percent, would be the 81,006 divided by the 2,040,000. If we want to use the gross margin, not the profit margin, the gross margin percent. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheets on the right-hand side, focusing in on the return on investment, ROI calculation. So the ROI calculation is something we're often going to use when thinking about a decision-making process as to whether to invest in something. In other words, when we're thinking about investing in something in order to get a return on it, then we will often have to put down that initial investment. How are we going to judge whether or not we should invest in one project versus another project, and so on and so forth? One calculation we can use to help make that decision: return on investment, ROI. So we're going to think about, what if we were trying to invest, expand to a new products? What would be the cost? What would be the return on investment of a decision such as that? So in any kind of decision where it lines up like this, it fits into this pattern where it's basically, well, you got to put down an initial investment and then you're going to get some kind of return on it. So what should we do that? And you can try to apply this calculation to it to help with your decision-making process. So the assets to support the expansion, we're going to say, are $500,000. We got to put the $500,000 down up front in order to support the expansion. Well, what are we going to get? The $500,000 as of now at this point in time. And we're going to think about our return on investment, let's say in a year, right? So we're going to say, okay, what are we going to get in the next year? The estimated revenue, $2,040,000. And then they give us the profit margin percent, which is going to help us to calculate the net income, revenue minus expenses, bottom line of the income statement, 4%. So what we really want then is, how did we do in the year? We want to get to that net income number. They gave us the gross number and they gave us the profit margin percent. So we can use the profit margin formula. Let's plug it into the normal profit margin formula we talked about last time to then get the net income. So we're going to say profit margin was the net income, which we don't know. So I'm going to make that yellow. The net income is the unknown. And then we're going to divide that by the sales, or the revenue, the estimated revenue, which we think is going to be that 2 million. Let's call it estimated revenue. So there we have that. And that's going to give us our profit margin. And that we know is going to be the 4%. So notice what I'm trying to do. I'm going to format this home tab. I'm going to go numbers, format that to a percentage. Let's put an underline under it. Let's put the double underline here, the single underline there. So what I'm trying to emphasize here is that if we don't know exactly how to use that percent to get to net income, you don't really need to memorize a new formula, although here you want to recognize it after a while. But we want to get into the practice of just using the formula that we know. I would write it down typically vertically, because that's how oftentimes you will see it in things like a tax return or any kind of form, then write it down algebraically. So now I'm going to say, okay, let's write it down algebraically, which would be x divided by 2040000. It's going to be equal to 0.04 or 4%. Then solve the algebra from there. And we're going to start writing this one vertically, because this is one that you will see quite often once you start working with a profit margin. So we're going to take the estimated revenue, which is going to be equal to the 2,040,000. I'm basically just doing the math now if we were to do the algebra here. And then we're going to take the profit margin percent, which we said was 4. This is going to equal the 4%. Let's make that percentage, home tab, numbers group, percentage. And then we'll multiply that out. This equals the 2,040,000 times the 4%. That's going to give us the 86,000. That's going to be our net income, which we could double check over here. We could say, all right, there's my net income. We just did the algebra here, so we could plug it back into this formula and then calculate this again, which would be equal to the 81.6 divided by the 2,040,000. Formatting this cell, home tab, numbers group, format as a percent, 4%. So we can kind of prove it there. So again, this particular formula, you're going to want to know it both ways. You're going to want to know how to calculate the profit margin, net income, divided by basically the top line revenue. And you're going to want to know how to take that profit margin and apply it to the revenue in order to calculate the net income, because that will often be the case as well, especially when you're thinking about projections and whatnot. So I'm going to put an underline here, but also you can always derive this whenever you're thinking about it. You can always, if they ask this, you could jump to here. You want to get to the point where you could jump to here, but if you need to rework it and think about the algebra, just start getting in the habit of writing it down this way until you just see it in your mind, right? And that's going to be a principle that we'll have going through as we work with many of these ratios. We want to start to think about how we can go back and forth working with these ratios and what's the easiest way to do that. We want to make this as fluid a process as possible. Okay, so then we're going to take our net income, which is our estimated net income would be, and that's going to be our return that we're going to get after a year. So that's what we're going to get. It's going to be the 81.6, and we're going to divide that by the initial investment, what we had to give up in order to get that. So the initial investment, we're going to say the investment to purchase assets was the 500,000. So the 500,000, and that's going to give us our return on investment, or the ROI. So that's going to be equal to, we're going to be taking the 81.6 divided by the 500,000. Let's make that a percent. Home tab, numbers, make it a percent. I'm going to add a couple decimals. You can keep on adding more decimals if you want it more precise. Looks like this one happens to round out at 1632, which is probably where you want to round it anyways. Adding more decimals to some point won't add any value after some point. And then you got the home tab numbers we're going to underline, and then we've got the double underline here. So there we have it. Now, so notice what we basically have here on the return on investment. We had to put down the 500,000. That's going to be on the bottom denominator, and then on the numerator, this is what we're getting after some time frame, which is often like a year. So this is what we're getting is being returned on the initial investment. Now we don't know if the initial investment. So if we were to sell this, you may still get the initial investment back. We don't know if you're talking about like a stocks and bonds and whatnot. Notice that you might put money down in like a stock. If you were to apply this to stocks and bonds, you might put money down to buy stock and then get some type of return and calculate, say, a return on investment, in which case you would still have the initial stock too, as well as the return that you might have gotten in some case, right? So there's different kind of scenarios in terms of how you're going to apply this return on investment, because you're going to have to compare it then to other decision-making processes that you might have. So in other words, is it good to have a 32%? Well, it depends. It depends if you have other types of things and you do an ROI calculation, they might have higher or lower percentages. So it's just one calculation that you're going to use for that. If you look at the industry average, then that'll also be an indication as to whether that investment's going to be useful or not. We will typically combine this calculation with other types of calculations to estimate into the future as to whether an investment is good or not. Remember, we're going to use these ratio analysis, for a better picture. We're kind of if we're looking into the future and projecting, we can't see into the future, obviously. It's like a fog. You can think of it kind of like a fog. We're just trying to put some peepholes in there with some of these ratios, which will help us to get a better understanding of it. And again, the more that we can do that, the more angles we look at the thing at, the better we'll be able to make a decision. So the ROI is going to be one of those factors for it.